Deepak, welcome to Corporate Connections Dubai Wisdom series.
Thank
Uh,
you.
I was checking that you recently renewed into your fourth year.
Yes, I did. Yeah.
So, congratulations, and we are excited to have you in your fourth year.
Good.
I was also going through your records, and I see that out of the 3 years of you being part of Corporate Connections, 1 year you were a chapter president. The second year you were part of the board that governs the chapter. So, thank you for your support. Thank you for your contributions.
Thank you. Thank you so much. It's actually a pleasure being in CC. It's just wonderful, the kind of learnings we get, the kind of stuff we do together, the extraordinary experiences, like they call it. It's just beautiful. That's why every year you see me renewing.
Thank you, and we are lucky to have you.
No, so blessed to be here.
So, coming back to the Corporate Connections Dubai Wisdom series, you have enormous experience, and we thought let's start this series with you so that we could share that experience with the audience as well as our CC members around the globe. So, you born in a business family. Your father is a successful businessman.
Yes.
You've been into textile business, logistics business, real estate business, and you understand the philosophy of not keeping your eggs in one basket.
Absolutely.
And so tell us, how did this startup scenario happen to you?
So it's a very funny story, actually. I got into logistics in 2015. 2015, I entered the logistics space, running my own business from scratch. When you start your business from scratch, it's the ups and downs are very different than when you just buy into a business. So it so happened that in 2015 I started Premier Logistics, and then I went into warehousing, storage, started doing everything from the very beginning and learning the ropes. So my first startup investment was actually a logistics company,
Okay.
based in India. That's how I got into this, looking at how can we partner with another logistics company, what can we do with them, and what is the value add they bring on board. So that was my first startup investment ever as an individual. And I think, like they say, because my logistics business itself was getting more successful, it was pretty much the warehousing storage was running on itself. So I was like, why not another successful venture? Let's get into a bit more. The tiger had tasted blood, I think. So that's where it was. And it just started off from there.
Okay, fantastic. So, as an entrepreneur, most of us know the conventional way of investments, which is we either go to the stock market, we go to mutual funds, we do fixed deposits, and many other such investments which are very, very conventional. And we are very well aware of how to track returns in those investments. But startup is a new field for many of us. So, can you give us some, insights into how do we track our returns on investments when we invest on startups?
Well, that's a very good question, actually, because what happens, it's very different from the traditional investments of stocks, mutual funds, the markets that we see as a general. Startup investment is something which is high risk, high reward.
Okay.
Traditionally, your stocks come at approximately 10% per annum average returns that you see. In startups, you don't see an annual return. Liquidity is something which is kind of tight in a startup because they always use their capital towards the startups. So that is something where it's a multiplier return if all goes as per plan. So ideally, what you have to look for is who is the founder, what is your trust in them, what is the concept idea. Do you like that idea? Like I said, my first startup was a logistics. It made very good sense for me to enter with them because I love the idea, I love what they were doing, and somehow or the other we can collaborate together and I can give it time. In a traditional stock, in a mutual fund, what you ideally have to do is, buy on the market, wait, see how the company is performing, sell. Public stocks are very easy to sell at the press of a button. Whatever the price today is, you can sell it at the press of a button. Startups are typically not the same. Startups, you'll have to wait for a potential exit, an acquisition, or an IPO. And that is when you make your multiplier returns if they go as per plan. Like I said, high risk, high reward. But it's a multiplier. It's not your typical 10% per annum. It can be a 2x, 3x, 4x, depending on what the concept is, who acquired the concept. So that's how they differ in general, traditional investment and startups.
And as you said, it's a high risk, high reward. So there are many cases of actually losing your money as well.
Absolutely. A lot of cases where you can lose your money. But in today's day and age, what I feel is, gone are the days where there was something called spray and pray. I love that term because what people used to do earlier, uh, they were sitting on idle cash. They would invest in startups thinking it's a great concept. I want to do it. Now sit and invest in 10 startups like this and pray that one startup does 100x multiplier. But today that's not the case. Today people have become more aware. Investors have become more aware. Funds have become more aware. They're looking at the bottom lines, profitability, what is their go-to-market strategy. They look at everything in terms of looking at it like a business, like their own business. So that's how I think it differs today than before, because spray and pray was something which was just by luck you're getting the multipliers. Even though companies are not even profitable, they're looking at potential revenues 5 years later, 10 years later, and still getting those valuations. Today it's not the case. Today people are actually studying those businesses.
Okay, good to know that. So somebody like me who has been into multiple businesses knows how to grow my money in a conventional way. If I want to start my journey in the startup world, how do I start it?
So I always, I always say it's part science, part art. Be connected to a lot of networks, angel networks, funds, startup founders. On a weekly basis, I meet a lot of people, who are connected to the startup industry, because innovation gives me that kick. If there's something new, I want to learn about it. I want to know about it. So be connected to your angel networks, to the venture capital funds, to startup founders. So there are various ways where you can actually get connected to them and then see if you like the idea, see if you like the founder, see if you like their whole strategy or the leadership team rather. Because for me also, it is not only about the idea, it's about the people behind the team that is executing it. Ideas are easy, but to execute that idea is what takes the most to take it from 1 to 100. So.
Oh, I heard that you said connect with your angel, the investors, founders, connect with the funds. So on that area, I have a question. What are the pros and cons of investing with the founder versus a fund that is investing in startups?
Very, very good question. I think it all depends on your investment preference, ideally. Investing directly with a startup is great if you've got some time and give some input. If you'd like to sit down with the startup founder, talk to them about the go-to-market strategy, talk to them about the long-term growth, the business goals, it's very, very good to be actively involved and feel as though it is your business. So their success is your success, pretty much. And not just monetarily, but also in a format of seeing that success, the startup grow from scratch. With a fund, you're hedging your risk. Because the fund has a particular size. They will take a minimum investment from you and they'll invest into various different startups. So your risk is pretty much hedged. And there you don't have to give any time whatsoever. The professionals are managing it. They're doing their due diligence. They're checking the startups. They're looking at what the team is, how the team is. Or even if, let's say a particular startup is failing, they will help them pivot the startup with their network. So, direct investment into a startup versus a fund, the difference ideally lies between your investment preference. Do you want to be actively involved or do you want to just let the professionals manage it?
Okay. And you also said that your first investment was into logistics startup. So how important it is that when you invest with a founder that you have some background of that industry or some understanding of that? Is it important?
I'd say yes and no. It's a two-pronged approach because looking at from where I came, I never had startups on my mind at that time. I went into it like I'm getting into a business. I'm getting into a partnership. That's how I entered into this. Then I realized the fact that, building a business from scratch, the amount of time and money that you invest is brutal, is way more than you could do by just buying into a ready business. So it all depends on your investment preference in terms of, are you looking to get into a startup industry with a concept that you like? For example, AI. Everyone's talking about artificial intelligence today. That's a new buzzword, But do people really understand AI, or are they just going for the .ai domain and seeing, okay, I want to do something in this, So understanding the industry is important, but being involved in the industry might not be important, But you have to have an understanding because your money is at stake. So it's very important to understand that kind of industry.
Okay. What about investing with founders versus funds? We said that I assume that funds will have more compliance because there's a better structure, more people involved, more documentation involved. But how do you make sure fair and transparent returns when you're directly dealing with the founder?
See, I think in my case, that's completely non-negotiable. Fair and transparent is something that has to be there in every startup. So it also will take a lot of due diligence on your part. For example, when you're investing with a startup directly, who is the founder? What is the team? What is their backgrounds? What have they done before? Have they had any successful exits before? Have they built a business, or have they been able to execute it from 1 to 100? That is very important. Then you look at their vision. What are they looking at? Is it realistic? Is it data driven? Are they talking real numbers, or are they just being like, okay, 5 years potential, we're going to be here, guys, and I need the revenue. I need the money from you guys. So it all depends on your due diligence, first of all. But an added safety measure comes in when you see marquee investors, when you see larger funds investing in it, because they've got a completely different set of due diligence, which you as an individual might not possess, So the investors, the larger investors, the marquee investors, when they come in, that things look good. They've done their due diligence. You can place your trust in him. And there is, according to me, some form of gut feeling as well. That's very important for me. I run a lot of things by my gut. So I always make sure I meet the founder. That's very important. I don't invest in a startup without meeting a founder. Once I meet the founder, I want to see what is their strategy, what is their vision. Will we also click, for example? Because it's like a business partnership at the end of the day. You're not just putting in money and expecting a multiplier return, You're investing in a business. Businesses can be successful, businesses can fail. So there is various aspects to each investment.
And the startup investment, would you call it a passive or active investment? And if I'm getting into the startup world, how many hours a week do you think I should keep in my calendar to focus on what's happening on my investment?
Well, CJ asking me a question about time management is something that comes to me. But I think there is no one size fits all. Okay. Active investment is where you actively want to be involved with the startup, look at their strategies, if you've got the time, if you can give the commitment, active is great. Like I said earlier, because you feel like you're a part of the success of the business. Yeah. The investment for an active investment also might require a bigger check for you to be on a board. Mm-hmm. Or if you just want to give your input, you're directly in touch with the founder. Like I maintain open lines of communication with all the founders. I will always make sure that I give them enough time if they need. If it's running well and they don't need me, great. But if they need any help, they face any entry barriers anywhere, if they want me to open any doors, I try to do that for them. So that's active investment. And then comes your passive investment, where people say that I don't have time. I don't want any commitment on my head. I like this startup. I like this founder. I know they're going to do well. Mm-hmm. I put my money on you. Right. So that's a passive investment where they put the money on the other person and now are reliant on him to grow that, are trusting him to grow that rather. So that's the difference between active and passive. But like I said, no one size fits all. It's very different.
So since somebody like me who wants to enter new in this field, what's some minimum investment from your experience is required to explore this startup world here? And are you expected to then keep topping up?
Good question. I think the last part will add on quite a bit. But I think an average investment also differs. A typical investment is approximately $100,000.
Okay.
But an average investment differs on which stage of the startup are you entering at. Mm-hmm. There are various stages of investments like family and friends round, seed round, pre-series A, series B. So typically a family and friends round would be somewhere around $50,000, $60,000, depending on what the startup needs for just starting off. They're asking their family and friends for help. That's called the family and friends round. Then comes the seed round, which is the concept stage. This typically ranges anywhere between $100,000 to $500,000, depending on what is the size of the startup, what is the TAM, the total addressable market of the startup? Is it very large, so they need to enter in large? Then comes your pre-Series A, Series A, which much larger checks. Typically, an investor can enter into a startup with anywhere between $50,000 to $100,000.
Okay, and so when does that ABCD stops?
Okay, very, very good. I think follow-on rounds.
Okay.
What happens is it's very important if you believe in a startup to keep going for follow-on rounds with them.
Yeah.
Why is that? So that you don't dilute any equity as the valuation grows. The company, example, company A is now doing well. You've put in money at the startup stage, at the concept stage, at the seed stage, right? Now that particular startup is growing and doing really well, has become profitable all of a sudden, is now raising another round at a much higher valuation. If there is investors at that particular valuation that are coming in, naturally your equity will get diluted quite a bit, right? But what happens is as you do a follow-on round, you believe in the startup, your equity will stay, but you average out much better than any other investors who are entering at a later stage. So follow-on rounds are also very important if you actually believe in the startup.
Okay, nice. So as a newcomer in this field, how do I identify opportunities for startup? Where do I identify these opportunities of the startup? And who should we work with to help us identify?
Like I said earlier, it's very important to be in touch with the industry. It's very important to meet the angel networks, meet VCs, meet startup founders, hunt for ideas. If you like a particular industry or an idea, visit the pitch decks. There are a lot of startup pitches that are going on all around. You have various incubation centers where there are startup pitches going on. I think it's very important to network well in this industry. It's very important to know who's doing what is the new startup that's coming up in one particular industry, which you feel is going to do well. So identifying an opportunity comes through that network. Like I said earlier, it's part science, part art. You really have to look for the right opportunity. And then comes the next layer of looking for the right founder, looking for the right team, looking for the right vision, because you just don't want to put in money in something and they don't execute it at the end. So identifying a right opportunity comes through that network, which will build that trust, So I think that's very important.
So in addition to networking with the right people, right talent, do you recommend any reading material or podcasts or YouTube channels or anything that can accelerate this process?
There's loads of them. I do podcasts almost every day. I listen to podcasts almost every day because learning never stops. And I think that's very important for you to be abreast of all the information that's out there. Today, it's like an information overload, and you need to make sure that your relevant industry, you pick it up pretty well. There are some great podcasts, YouTube videos. All you have to do is start a podcast on Spotify, and you'll find phenomenal amount of startup podcasts. So I think listen to podcasts, definitely. It's a definite. You learn various terms, various things that are involved. A lot of people will come to you. A lot of startups will come to you and be like, listen, we need some money from you, but we're not going to give you equity right now. We'll give it at a later date. You'll be like, what? You're taking my money, but you're not giving me equity today. So all these terms are defined very well. All these terms are explained very well, where the equity comes in at a later date. So everything is explained. So I think it's very important before just diving into the industry to learn a bit about it, to know a bit about it. It's exactly like your business. When you enter your business, you just don't enter into a wild forest. You learn something about it at least, and then you build the team around it to start growing it. So
sure. So what I suggest is, after this session, if you can share some links with us, we'll link them below for our viewers so that they can accelerate their journey.
Absolutely. I'll put in a lot of links.
So coming back to your own experience, because I know personally that you've invested into a lot of startups. So do you want to share a success story and a failure story and your learnings from those?
Sure. I won't name the companies. I'll tell you the industry. Some of the investments are basically some of the successful investments. So, you see success and failure both. Yeah. I think there's a very famous saying by Robert Kiyosaki, which says winning and losing are both part of the game. It's an emotion, and you have to be neutral to that emotion. So it's just part of the game, and that's how you learn. So for example, one of my startups, the logistics startup that I said in the start, has done successfully well, has done phenomenally well, has grown leaps and bounds, is probably one of the best logistics startups in India at this point. You know, they've done very well with great multipliers in return, and I still continue with them. That's my logistics one. We've got another one, which is a revenue-based financing company. It's a fintech. Again, grown leaps and bounds, done really well, expanded from India to UAE, now are doing some phenomenal work. It's a startup where they do revenue-based financing for smaller businesses, for businesses which do not want to borrow from banks or do not want to give out equity. So they directly club onto their POS systems, take the revenue-based financing from them. Great concept. They've done very, very well. But everything's not hunky-dory, you know. It's not a smooth sail in this industry. I've also had some failures in the process. There was an edtech startup which had reached almost a 20x multiplier return. But within a span of, I think, 3 months, 4 months, it saw the entire valuation decline because of the fact that all their eggs were in one basket in one particular country.
Okay.
And the government regulations changed over there completely. So they were forced out of business within a period of 3 months, even though they tried their level best. So that investment completely tanked for me. So it's a mix of both. You'll see successes, you'll see failures, but it's how you keep up with them and you move forward.
So on the failure story, is there anything you could have done differently that would have saved you from the loss?
I think not put my eggs in one basket.
Okay.
That's very important. The execution would have been a bit different. There has to be persistence in the leadership. I think that's very, very important. You look for a founder who's very persistent, who is a go-getter. The founder wants to do it regardless of what there is. Not just, it's very important to try and figure out what next. But if you don't have a roadmap for the next 1 year, 3 years, and 5 years, then it becomes very difficult for a startup to even know. Government regulations can change anytime. Right. Anything can happen at any time. So it's very difficult for startups to judge what next. But if they've got plan A, plan B, and they pivot fast, I think that is where the traction, the pivoting, because the industry is brutal, like I said, everyone is on top of each other doing innovation every single day. Yeah. So it's very important to be ahead of the curve.
Right.
That's important.
Great. So the startup scene in India is hot and has been hot for many years. I see that UAE is also picking up on the startup scene. So would you want to share any experience of investing in startups in UAE versus startups in India? Pros and cons, and how to go about it, and what works for you, what doesn't work for you?
I think it's all pros, to be honest. India is very diverse in nature. India is fast, diverse, a very young population, already an established startup industry there. So what it does is there is your go-to market strategy is much faster because it's a much larger population. It becomes easier for you to tap into the market because your addressable market is way larger. UAE on the other scale is focusing a lot on high-tech, logistics sectors for startups. And when you look at that, I think they are more prepared to take the company international. So on day one, you've got quick adaptability and international reach from UAE.
Okay.
Whereas once you're in India as a startup, it is such a massive market that you don't even think of stepping outside, which comes 3, 4, 5 years later. Okay. But from UAE, I think the reach internationally is much faster because they've got 200 nationalities here, so you're pretty much catering to almost everybody, In India, it's a very fast-cultured, very diverse, innovative market. So there's rapid access in India, and in UAE, there is rapid global expansion. So I think that's the two differences there is. But both have their advantages of being in each country. The government is really supporting in both the countries. There is a lot of support for startups. There's a lot of support for innovation. So you see a lot of the younger generation. You see a lot of people come up. Like yesterday, I was watching a story where a 13-year-old kid is innovating something that is phenomenal. So there's loads of stories out there, and the government is now starting to support it. So each country, I think, is doing phenomenally well, and they need to keep pushing the startup industry.
Deepak, thank you for sharing this, and this domain is so interesting that I can go on and on asking you questions. But I'm going to go to my last question because
Sure.
both of us are part of the CC Dubai community. So my question is to you on how can you help the CC members, whether they are in Dubai or internationally, because we are a global community, to get settled in this startup space? What can you help us with?
I think first thing is I always tell people who want to start investing, it's your money at the end of the day. It's very important for you to do your own due diligence. But always start small, think big. Start with just a minimum amount to see how things are. Don't go all guns blazing. I'd love to support these startups, connect, take people who are interested to startup events, to connect them to the venture capital funds, to connect them to the angel networks. I'd be more than happy doing that. So if any member that needs anything that is required for investing in startups, how do we do it? What do we do? The basis of this conversation can go further, and then I can definitely sit across with them and help them out.
Thank you, Deepak. I think thank you
you.
for sharing your wisdom. And I'm sure that once this podcast is published, you're going to get a lot of one-to-one requests from our CC global community.
I'd be more than happy to do that.
Thank you very much, Deepak,
Thank
for
you.
joining us.
Thank you so much.
Thank
Thank you.
Welcome to CC Wisdom. Corporate Connections Dubai has started this initiative called CC Wisdom for the global CC community, where we share our members' knowledge and learnings with the audience. Stay connected and follow us on LinkedIn for more updates.